Okay, let's look at problem 6-32, which relates to accounting for continuing expenditures, and we're talking about long-term assets. So continuing expenditures related to long-term assets. Okay, so what does the problem say? Well, it says Tower Company owned a service truck that was purchased at the beginning of 2018 for $49,000. It had an estimated life of 3 years and an estimated salvage value of $4,000. Tower Company uses the straight line depreciation method. Its financial condition as of January 1st, 2020, so we're in our third year now, is shown in the following financial statement module. Okay, or model, I should say. So what do we see? They had $38,000 of assets. They had $49,000 is the cost of the machine. Well, that makes sense because there's the $49,000 they talked about. They've taken $36,000 of depreciation through the end of the year 2019. Common stock is $16,000 and $35,000 retained earnings. Okay, now what now? Since it's the beginning of the year, there's no revenue or expenses, right? No impact on income, no impact on cash flow. And then we're asked to evaluate these 4 or 5 transactions, or expenditures that they spent on the truck. Actually, that's the kind of expenditures they had. Okay, so they overhauled the engine for $7,800 beginning of the year. Estimated life was extended 1 additional year. That's important. And the salvage value was revised to $3,000. And then on July 6th, they obtained an oil change and transmission service. They replaced a fan belt and battery and purchased gasoline for the year. And then, of course, at the end of the year, they recorded depreciation expense. But the depreciation expense has changed. All right, so the first thing we have to do is we have to look at these transactions and say, well, did they have an impact on the asset, or are they just an ongoing expense? The first one extended the life of the equipment, so that definitely had an impact on the asset, which means we're going to affect either the cost or accumulated depreciation. And because we're extending the life, we're going to impact accumulated depreciation. Now, I'm going to walk you through that one. So down here, we drop in the balances that were given, right? So there's the $38,000 in cash and $49,000 in machine. We see that here. And the other 3 items are listed. So on January 4th, we overhauled the engine for $7,800. So we think we're going to see cash go down by $7,800. Okay? Now, they don't specifically tell us it was cash, but since there's no other choices here, it makes sense that the decline in the assets was cash. And since we extended the life, the correct way to record that would be to reduce the accumulated depreciation. Right? We don't treat that as an increase of the base cost of the machine. Instead, this overhaul extended the life. It essentially reduces accumulated depreciation. Okay? Now, in cash flow, it cost us $7,800 cash, and since this is impacting a long-term asset, it would be considered an investing activity, right? It's not an operating activity. Now, if you look at the next 3 transactions, those are all just ongoing expenses. None of those impact the asset. They don't extend its life. They don't extend its operational capacity. It doesn't improve the asset in any way. They're just ongoing maintenance expenses. So as a result, there's no future economic value to any of those. So they're expenses. We expense them when they're incurred. Okay, so for the next 3, we're probably going to see increases in expenses, decreases in cash, but I'll leave that all up to you to solve. Then we get to the last transaction where we have to record depreciation for the year. All right, now I've readjusted the screen so that we can see some hints here, but I've blacked out some of the answers because you need to solve that. Okay, so you have to calculate the new depreciation for the last year. Remember, they gave us the balance at the beginning of year 2020, so we have to calculate depreciation expense. Now, they use the straight line method. Okay, so that's easy enough to compute. But what do we know? Well, we know that depreciation in the prior 2 years was $49,000 less the salvage value, right? Cost less the salvage value divided by 3 years. And as far as we know, there was no impact in the prior 2 years. So depreciation expense already taken for those 2 years is pretty straightforward. But in 2020, we've got this overhaul to consider. Remember, that's going to reduce accumulated depreciation, and these depreciation expenses are essentially increases to accumulated depreciation. Also remember that cost less accumulated depreciation is the book value. Okay, so the point of this schedule is we have to come up with the new book value, and the new book value would be equal to cost less accumulated depreciation plus or minus the impact of the overhaul that occurred this year. That'll give us a new book value. We still think it has a salvage value of $3,000. We used to think it was $4,000. I slid up. The reason why it's $3,000 is they tell you that when we did the overhaul, we extended it one life, but the salvage value is now revised to $3,000. Okay? Let me slide back down again. Get this back to where it was. All right. So we have a new cost minus the salvage value would give us our new depreciable base. I call that the depreciable base. They're calling it the new depreciable cost. Okay? So we have to take the depreciable cost, and now we're dividing it by 2. Now you may be confused on why that is. This is the 3rd year, but that overhaul extended it to 4 years. So now we have to take the new revised cost, the book value, and divide it by the 2 years we have left. Okay? And that's how you calculate what the new depreciation amount is. And then you want to reflect it in our financial statement model format up here. Okay? So I think that'll be helpful to you in working through this one.